So what does all this mean for you and your investments? Joining us now, Jeff Rosenberg. He's Chief Investment Strategist for Fixed Income at BlackRock, and Jeff Sott, Chief Investment Strategist at Raymond James. Welcome to the two Jeffs tonight. Let me begin with Jeff Sott first to get the conversation going. You know, Jeff, a week ago, last Friday, we got those nice comments from Vladimir Putin of Russia, and stock market rallied and stock investors were very happy. This Friday, just the opposite, more money going into bonds. Who's got this right? The people who are putting their money into stocks or bonds as this Russia-Ukraine situation develops?
Well, typically the bond market is smarter than the stock market. In this case, I think it's a flight to safety. The German 10-year bond dropped under a 1% yield. So on a competitive basis, the flow of funds into our treasury market makes sense to me. But the economy is recovering, except for the retail sales that we had this week. And I think stocks are a buy on any dip from here.
Let's go to fixed income, Jeff. Jeff Rosenberg of BlackRock. I think we kind of know why bonds rose in price, down in yield today and in prior days. But let's move the film forward into next week. What do you expect? And specifically, what do you expect out of the Jackson Hole conference where Ms. Yellen and several other central bankers will be?
Well, it's been a general conversation so far talking about bonds and talking about stocks, but what we're not talking about is really which bonds have benefited. And the key here is, historically when investors think about flight to quality, that benefits a shorter maturity bond. This time is very different. What's happening is the flight to quality flows are going into the long end of the yield curve, and that's because we're at zero interest rates, and there's very little upward price movement that can benefit investor portfolios from a flight to quality into the front end of the curve. So the move has been all in the back end of the curve. Now, to answer your question, Tyler, what do we expect next week? Well, certainly it's hard to predict what's going to happen in the Ukraine situation. Any alleviation of that concern, then you're going to see some of this back end, longer maturity move downward in yield come off a little bit as you relieve some of that flight to quality bid that we saw this week. Obviously, that depends on what happens in the geopolitical situation. To your question about Jackson Hole, that's really about expectations for Fed policy, and that impacts shorter maturity bonds. And so that's really about what's the outlook for 2-year, 3-year, 4-year, 5-year type maturities. What I expect next week is for Janet Yellen to reiterate what she has been saying all along, that the labor market recovery is not fully or sufficiently in place for them to begin even contemplating tightening interest rates. You're going to hear a very dovish message from the head of the central bank. Next Friday at 10 a.m. is her scheduled speaking time.
So, Jeff Sott, what do you think about that? I mean, let me ask the question, frame it a little bit differently. If these geopolitical events were not a factor, would we be seeing any of this action with bonds? Or is there something going on in the Treasury market and in the U.S. economy that gets so many bond market fans?
I think it's purely a flight to quality. I think it's a competitive yield basis from around the world. You know what the yields are in Japan. You know what happened in Germany. We look pretty good. I'm almost assured of Draghi's statement that he's going to continue, in essence, a quantitative easing policy. I mean, that takes the euro down against the dollar. A strengthening dollar is positive for the U.S. bond market. It's also very positive for U.S. stocks.
Jeff Rosenberg, I want to get in touch with my inner bond geek here without getting too technical. When you describe the idea that long-term interest rates are coming down because that's where the flight to safety is taking it, and you have what's known as a flattening yield curve, that typically signals something endemically wrong in the economy. And when the yield curve inverts, it's usually a sign of a recession. Do you see that?
No, and it's a very good question, Tyler, and it's one particularly in the context of, stock investors versus bond investors that's very important for investors to understand about what's different this time when you're seeing that flattening of the yield curve, when the differential between long-term interest rates narrows relative to short-term interest rates. As you just mentioned, typically that's a recessionary sign that's often interpreted as a bad news for the stock markets. Be careful about using that typical interpretation this time. The reason being, you're at zero interest rate policy, and so there's really no room for the front end of the yield curve to go down. So I would say that the flattening of the yield curve that you're seeing today is very different. It's not as negative of a signal as you would typically attach to the bond market signal for equity market investors. It's really about much more the flight to quality issues, what the other Jeff mentioned a minute ago, the relative yield story globally in the low yield environment. 10-year interest rate yields in the U.S. are gaining attractiveness, and that's helping to push their yields lower as well.
All right, gentlemen, thank you very much for joining us on this Friday. Jeff Rosenberg at BlackRock and Jeff Sott at Raymond James.